now time to talk investments, thanks to our partners Forsyth Barr. With me in the studio today is investment advisor Mark Richardson. Mark, good morning.
Morning, Ron.
Good to see you. So investing, we talked about this before, but investing when markets are at a high, which they are, they went down and then come back. Does that mean now's the time to invest, or did we miss the boat?
Yeah, there's a lot of chatter around at the moment because the S&P just keeps going up. There's a lot happening that keeps defying what's been going on, and people are going, "Oh, when's this? Is this sustainable? Is this going to turn?" And it's creating a bit of nervousness. And every time I come in, we always say, "Time in the market, not timing the market." So it's probably a great time to just talk about the fact that why we say that. And if you have a look at when markets have had dramatic downturns, so some of the crashes, so the 87 crashed 20% in a day, it had recovered all that in a couple of years. The GFC is probably not the greatest example because that took about sort of 5 years to recover, but that went down 55%. Very, very quickly.
Sure. I didn't realise it was that much.
Yeah, it took about 5 years to regain. And then we had, of course, COVID, so about 30% was wiped off in about a week, but it took less than 6 months for that to be recovered. So the point being that no one really knows when this is going to happen. And if it does happen to you, if you happen to have got in at the highest, it's basically just the best advice anyone can ever give is just sit it out because it doesn't take long to recover. Then you look at the statistics of if you are someone who's trying to time the market and you miss the days when it jumps, because generally the best days are quite close to the worst days. Now, if you put $100,000 into the S&P over a 20-year period, and you just left it in there through ups and downs, over 20 years you'd probably have about $650,000. You turn your $100,000 into that. Now, if you miss the 10 best days, and no one knows when those are really coming because you're in and out of the market trying to time it, you can more than halve your return, which sort of puts things into perspective.
It's like gambling. It's like gaming if you're doing it too often, or trying to time it, as you say, to get the highs or get the lows.
Yeah, well, I mean, obviously investing is the polar opposite of gambling because in gambling the house always wins. Whereas in investing, generally the rules and history says that if you're in it for long enough, you will actually beat the odds and you'll win. But if you're going to try to play the old speculative game and be a bit of a day trader, then you are turning investing into a little bit of gambling, which is what we want to avoid.
Yeah, and how do you avoid that panic sell as well, which is often a temptation?
Well, that's probably a good chunk of what we do as advisors is, when things do turn a little bit south, get on the phone, talk to your clients, basically reassure them and just show them what's happened over history. Have a look at their general financial situation as a whole, and just help them to wait it out. Help them to stop doing something really silly because it basically is when things turn rough. It's don't crystallize your losses. Sit in there, wait it out. Make sure you can wait it out. And then get ready to go again. And what happens is often people don't realise that those really good days in the market. You have a look at Liberation Day, down it went when old Trump had his board. All of a sudden, not long after that, there was a small announcement, and the market jumped 10%. Now, if people had freaked out after Liberation Day, they're going to miss that 10%. We want to make sure people are in the market to get that 10%.
Yeah, it's annoying with Trump because you just don't know. I think what happened was everybody was like expecting him to just be all talk, and then Liberation Day came and it was like, oh, he's not just all talk, but then he totally has walked back a lot of what he was going to do, is a lot softer.
Well, and the other saying is the market something happens, the market reacts and the market overreacts, and then the market realises that it's overreacted. And then it starts to actually correct itself. But it is a bit of an irrational beast. And the only way to really make it play on your side is just be in the game. And be in the game, if you're going to invest in equities, be in the game for 5 or more years.
Yeah, good advice. Mark, good to see you.
Cheers.
Take care. As always, thanks to our partners Forsyth Barr. That's Mark Richardson, investment advisor.